It's been 1 year since the S&P 500, Dow, and NASDAQ all began to recover from what was the worst ever Christmas Eve sell-off. In 2019, all major indexes are up more than 20%, but will the rally last? Joining us to discuss this is Rich Steinberg. He is Chief Market Strategist at the Colony Group. And we want to take a look into 2020. You're forecasting that the S&P 500 will stay in a range between 3,000 and 3,500. Is there any case you could make as to why, and I'm going to be optimistic, we could break out above that?
Yeah, I think the only way we break out above that is if we have a replay of this year where investors are willing just to pay up for earnings. You know, last year earnings were supposed to come in for 2019 at $174. They came in at 165, so you had earnings compression and P expansion. So the only way we could really go above 3,500, in my opinion, is if people feel that there's just no other place to put their money. You know, next year people are looking for 178.5 in earnings. That may be too high, but at 19.5 times multiple, you get to 3,500. So you'd have to really trade at extremely high PE levels in order to get more bullish than where you're at. It could happen if the dollar weakens and earnings surprise to the upside from overseas earnings.
So if it's sort of steady as she goes, range bound, Rich, how do you get a leg up in this market? What do you think will outperform? Are there areas of the market that you think will do better, or is it other assets entirely?
Yeah, I think you have to kind of get paid to wait and see how the economy and election plays out. So I think there's definitely a sense to overweight some dividend names where you're getting paid 3 or 4% to wait with a total return of 7 to 10% if the markets do okay. And, some sectors are beaten up like financials. So if you start to see a rotation to go back there may be some momentum. Don't forget, you have a lot of algos that are controlling between ETFs and algos. You're looking at 70+% of the market's volume being tied up in those kinds of trades. So momentum works both ways. So I think it's really time to kind of watch money flows and just be smart about what you're willing to pay for that next incremental earnings.
Rich, Jared Blickery here. We talked about your bull case. Let's talk about the bear case. What takes the S&P 500 down to 3,000 or even below that? Number of headwinds out there. You pick them, but what's on your radar?
Yeah, so I would call this like the Goldilocks versus the three little bears scenario. We talked about the Goldilocks, everything kind of being not too hot, not too cold. The three bears, the three little bears pigs looks a little bit different, right? It's earnings don't come in. You have earnings compression. If we're at $171, and if you say that you don't get PE expansion because earnings come down from consensus, you get to about 3,000 at 17.5 times. If the first phase of the China deal doesn't look as robust as people think it is right now, that could be an issue. Of course, the bond market could play a little bit of havoc if we go through the 2% level and you have reallocation of macro funds going from stocks back to bonds over the 2% level. I think that's why you stay invested where you are now, knowing that there's probably a little bit of asymmetric downside risk to this market, but overall, I think you're going to be in a trading range of, plus or minus 6%. We would expect some profit taking to occur in January or February.
I want to interrupt you, and I want to put this in a context that all of us can understand. So help us if we were your clients, based on what you just said a minute ago about watch, capital flows. Last 2 weeks, we've had people on the show who've talked about $1 trillion just in money markets. We've written about the fact that we're seeing flows back into equities, but there are people who are saying that this is fear of missing out, and that's the end of a cycle. So if I were your client, if we were your clients, and we were calling you right now saying, hey, we want to get in on this, what would you tell all of us?
Well, if we have cash on the sidelines, we would just be opportunistic if the markets pull back to add some exposure. And really, the whole FOMO, or fear of missing out concept, really is tied around greed and fear. And the fear gauges are way low, and the greed range is way up in this market. So this is time to be patient with sideline cash. You don't need to be fully invested. Just be willing to make a little bit less to know that you can protect the downside if there's a pullback.
I think the headline there is time to be patient with sideline cash, because we've had others on the program who say better jump in. But Rich Steinberg, Colony Group Chief Market Strategist, good to have you here on The Move.
Okay.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.